Hello, I'm Sandy Cochrane, the VAT partner at Gravita, and today I will go through some scenarios where VAT, which is already a complex tax, is important to understand when it comes to land and property transactions, and why, when a VAT expert is asked a question, the usual response is, it depends. Before we go on to the intricacies of land and property VAT, I thought I'd share with you some interesting statistics. So historically, VAT has been considered a support service. However, through the years, this has changed rapidly, with UK VAT being one of the largest income streams for HMRC. You'll see on the slide, we've got income tax coming in with just under 250 billion and national insurance at just under 180 billion. Those are obvious, that's the tax that will come through employment taxes, so we expect that to be quite high. But looking at the figures there for VAT, 160 billion, I mean, that's nearly twice as much as corporation tax. And the reason that VAT is so high is, one, yes, it's a transaction tax, so VAT is normally applied throughout a chain. And secondly, there's a lot of penalties and interest that's being applied for inaccuracies. So just wanted to really emphasise the importance that's being placed here and on the VAT accounting that comes with it. So the presentation will highlight the complexities of dealing with the VAT when it comes to land and property transactions. It's important to get this right to ensure HMRC have the correct amount of VAT at the right time and minimising the penalties for getting this wrong and adding to that generous pot that HMRC already have. So we're going to start with residential property. I'm going to talk about commercial, then I'm going to talk about mixed use, which is the residential commercial together. So starting with residential property, homeowners tend to do a lot of work on their property, and the question is, do they do the works themselves qualify for a reduced rate of VAT? So normally the standard rate of VAT is 20%. But for the likes of you and I that are doing up our house, that can be quite costly. If there's an opportunity to save 15% of that VAT and get the works applied at 5%, then let's look at those areas that's possible. Terminology is really key, as often I get asked about refurbishment of a property, for which, as I say, the VAT would normally be charged at the standard rate. However, by delving into the works, in some cases, the refurbishment involves some kind of building works. So the key is to distinguish between what is refurbishment and what is building works. We then also come on to properties that are being converted, where there are extensions being added on or additional floors. And the key to all of that is to understand what those additional extensions, the conversions, or the additional floors are going to create once the work is done. And once we understand that, we can then advise on whether or not the reduced rate will be available for those works. Continuing with the residential, there are also some nuances with empty homes, and we found that a lot with COVID recently. So there are two criteria for empty homes. They need to be vacant or unlived in for at least 2 years. There's also a 10-year vacant period of time where we can manage to get that at the reduced rate. So from January 2008, certain renovations and alterations to residential properties that have been empty for at least 2 years or 10 years can be eligible for that reduced rate of VAT. This applies to labour, materials associated with the repairs, alterations, construction, and also taking into account some garages and hard landscaping. So there's a lot to consider. This was and is continuing problem is, as I say, with COVID, a large number of houses were being left empty, being passed down to family, and the questions I was getting was about the works to bring those homes back up to scratch. So to minimise the VAT paid, careful consideration needs to be given to who supplies the materials, and it and it will usually pay to work with a VAT registered builder, as the saving of 15% materials supplied and fixed will usually outweigh the saving of the 20% on labour. There's no equivalent reduced VAT rate for DIY work, and I'm going to come on to that briefly in a moment. So as I say, empty homes, 2 years or 10 years, quirks for DIY builders. And again, we just really need to understand the nature of the work to see whether or not the reduced rate will be available there. So for DIY builders, if you are a DIY builder, the VAT incurred on certain works relating to that build or a conversion, say, for example, you've got a commercial property or a care home that you're now putting in, changing into a main household, you can do a DIY builder's claim. And again, there's certain criteria and conditions to be met. Building a house can take years. You can imagine the amount of invoices that need to be collated. All the original invoices need to be submitted with the claim. So it's quite a lot of work that needs to be done. There's a long list of items for which VAT can and cannot be claimed. So again, it's really important to get the advice right from the outset. I've known HMRC to reject DIY builders' claims because some of the information wasn't correct. So they just reject the whole claim. And it then becomes very difficult for us to then go through item by item as to what you can and can't do. Now, the claim for DIY builders, and you're hearing it hot off the press today, used to be within 3 months of completion. That time period has been extended to 6 months, which is a welcome relief because, as you can imagine, to get all the invoices in order after a long build, it's probably going to take more than 3 months to get. So that's a really good initiative that HMRC have announced recently. So we're moving on to commercial property, and it's really important to understand the history when a plot of land or an existing property has been acquired, as it may impact the VAT that we're looking to recover and also the VAT treatment of any future supplies. So a little bit of background, default position on property is that a supply of interest in land is exempt from VAT, meaning that no VAT's to be charged. But actually, the downside for exempt is that VAT on related costs will not be recoverable. This is a big difference to making a zero-rated supply, which can happen in commercial property, for which VAT on associated costs is recoverable in the normal way. Apologies, zero-rated on residential. This is how confusing it can be. So with the exemption, there's a facility to notify HMRC that the supplier wishes to charge VAT on its supplies of that commercial property. And this is also more commonly referred to as the option to tax. So where the supplier has notified its option to tax and is to charge VAT on that transaction, the purchaser needs to then consider its position and intention with any build and subsequent transaction. So where land has been acquired to develop on, care does need to be taken with any options tax. We continue with commercial property and the importance of understanding what the intention is to do with the commercial property. So a first sale or a grant of a lease in a newly constructed commercial property will have a different VAT treatment. For the sale of a newly built commercial property, this is usually automatically standard rated if that sale is made within 3 years of completion, 3 years being when the architect signs that off. And that's always a standard rated supply, no need to opt to tax. However, if the supply of the commercial property is going to be by way of a lease, then we do need to opt to tax. So we do need to understand what is going to be happening. If there's to be a transfer of a business as a going concern, perhaps as is in most common scenarios, the property has tenants for which the current owner receives rental income, and those tenants will continue to pay the new owners that rent. That business is the rental income. The VAT position of the seller needs to be matched by that of the purchaser. So where the seller is VAT registered and it's opted to tax, the purchaser will need to do the same, but this needs to be done at the right time. So please take care when dealing with transfers of going concerns. The other point to mention here is that if property itself is a capital item that has time left to run from the 10 years that I'm going to talk about shortly, then the purchaser inherits that capital item and has to pick up from where the seller left off. So therefore, if the purchaser inherits that capital item that still has a few years left and the purchaser makes an exempt supply, it'll be the purchaser that will need to repay that in proportion to the remaining periods. So something to be aware of. So with regards to the capital goods scheme, where there's an acquisition or an enhancement or expenditure on property, where the value is for £250,000 or more plus VAT, and that VAT has been claimed back, we need to look at the use of that asset over roughly a 10-year period. So, for example, if a property was purchased for £1 million with VAT of 200,000, you're roughly looking at £20,000 per year. So that 200,000 of VAT divided by 10. Each year you're saying, okay, year one, if I've used it for wholly taxable purposes, I can bank that 20 grand. But if after 4 years, the purchaser makes a supply and it's exempt, and there are different ways why that supply can be exempt, it will need to repay the balance of the VAT. So after 4 years, if there's an exempt supply, 6 years, so 6 times 20 grand, there'll be 120,000 that will be repayable to HMRC. So it can add up quite quickly, and it's important for purchasers to know what they're buying. And just a little reminder on the notification of the option to tax. So as from September last year, HMRC are no longer issuing acknowledgements, but issue an automated response. Therefore, it's very important to get the right advice, as once an option to tax is made, it's usually in place for 20 years, unless it's revoked within 6 months of notifying that option. However, there are certain conditions that are required to be met for that revocation to be possible. In addition to the above, where a business holds a property portfolio, for example, where income is both VATable and exempt, so we can have commercial property that has exempt income, or even residential, and we have taxable income because we've opted to tax, let's say, the commercial part, the business will be known as a partially exempt trader. And what it needs to do is allocate or attribute the VAT on costs to its taxable income and exempt income, and basically not be able to recover the VAT that relates to the exempt supplies, with a bit of a calculation going on there. So under the partial exemption calculations, these are usually done each VAT quarter. The amount claimed is provisional. There's a true up at the end of the year that's via the annual adjustment. So again, care needs to be taken to understand how the VAT is getting accounted for. So there are many different ways to approach that position with regards to a mixed use property or site. As I've mentioned, mixed use is where the property portfolio comprises of commercial and residential. And we see this quite often where a property has commercial units on the ground floor, residential apartments above. So we can use floor space method to apportion VAT. Or we can use rental income, or we can use another method that's most appropriate to suit the business. It's not one answer that suits everybody. So today I've just counted through the VAT, but as you can see, it's a highly complex area for which care needs to be taken to ensure that that is accounted for correctly, to avoid penalties for inaccuracies and possible interest that HMRC may impose. We don't want to increase that pot for HMRC from its current level of 116 billion and top that up with penalties and interest. So it is worth paying for the advice than to incur the penalties. So do come and speak to us, as we can assist navigating through what can be a complex area. And I haven't even mentioned construction industry or the domestic reverse charge yet. Thank you for listening today.